Welcome back. All right, in our last explainer, we really laid down the groundwork, right? We went over the three golden rules: buying strong stocks, shorting weak ones, moving to cash, and we mapped out the four stages of investing. Well, today, we're cracking open stage two, trend determination, and we're going to answer what is probably the single most important timing question in this entire framework. Why does the stock market actually move before the broader economy does? Trust me, once you get this, it's absolutely going to change how you look at the daily news. Okay, let's dive right into this because we're looking at a classic paradox here. It literally trips up millions of investors every single year. So imagine this. You wake up, pour your morning coffee, and you see this glowing newspaper headline: unemployment falls to a 10-year low. Sounds fantastic, right? But then you check your screen and you realize the stock market has been quietly, steadily dropping for 2 solid months. So you've got these amazing economic headlines totally clashing with a falling market. What do you do? Which one do you actually trust? Well, here's the reality check. Waiting around for official economic news, like those great employment reports, that basically means you are trading the past. Those reports are just telling you what already happened. But stock market prices, they are all about trading the future. So the answer to our little coffee time quiz: you've got to trust the market every single time. The market doesn't care what the economy did yesterday. It's busy placing massive financial bets on what it's going to do tomorrow. To really wrap your head around this, there's one crucial set of numbers you just have to memorize: 6 to 12. The stock market cycle leads the business cycle by roughly 6 to 12 months. It's kind of like, imagine two clocks running side by side. One is the stock market, one is the business cycle. But the stock market's hands are permanently cranked 6 to 12 months ahead. So, next time you're tempted to sit on your hands and wait for the official news of a recession or a boom before making a move, remember those numbers. By the time it hits the newsstand, the market has usually already priced it in and totally moved on. There's actually a formal term for this. We call the stock market a discounting machine. Basically, it's this massive system that is constantly pricing in what it expects to happen half a year to a full year from now, not what already went down. Stock prices are really just reflecting investor expectations about future corporate earnings. Nothing more, nothing less. If you wait for the news to confirm things, you're literally reacting to data that the discounting machine already chewed up and digested months ago. And hey, this is exactly why stage one, monitoring movers, has to be a continuous habit. That lead time only gives you an edge if you're actually paying attention to it. And this brilliantly illustrates the exact mindset that separates the amateurs from the pros. Think of the stock market like a giant offshore weather radar. A powerful radar system can spot a massive storm building miles and miles out over the ocean, way before a single raindrop ever hits the pavement in your coastal town. If investors sense a recession is brewing 12 months out, the market starts its early bear phase right then and there, even while the headlines are still throwing a party for record employment. The radar sees the storm long before the guy on the street feels the rain. Let's look at the 2007 case study to prove this with some hard numbers. Let's quickly walk chronologically through the 2007 crash, just to see how this translates to historical reality. So the S&P 500 actually hit its absolute peak in October of 2007. The market radar spotted the storm and started to roll over. But get this, the National Bureau of Economic Research, the official scorekeepers of the economy, they didn't officially declare a recession until December, a full 2 months later. And honestly, by the time that announcement came out and the headlines finally caught up, the market had fallen significantly farther into an early bear phase. The professionals, they were already positioned for the downturn way before anyone got the official memo. Which brings us right back to that opening quiz about unemployment. Why is a 10-year low in unemployment such a deceptive trap? Simply put, because unemployment is a lagging indicator. It usually only improves after the economy has already peaked. It's looking in the rearview mirror. So when you see glowing news combined with a falling market, that is basically a giant flashing red light warning you that the early bear phase has already kicked off. We're actually going to formalize this whole framework of leading, lagging, and coincident indicators in an upcoming explainer, but definitely keep that deceptive dynamic in mind for now. So the crucial point here is this: good news plus a falling market means you trust the market, period. That is the ultimate professional mindset. An amateur, they'll look at a really strong GDP print or a great jobs report, and they'll stubbornly hold on to their stocks even as prices crash, thinking, oh, the market's just wrong, the economy is doing great. But the professional? They look at that exact same data, see the market completely diverging from those headlines, respect the discounting machine, and start moving to cash or shorting. Let's wrap all this up into a clear, actionable mental model you can actually use in your own routine today. Step 1. You absolutely must monitor the macro movers continuously. Keep your eyes peeled on the data and the indices. Step 2. Actively look for divergence. Spot when the screaming headlines don't match what the market is actually doing. And step 3, when you do spot that divergence, please do not just dismiss it as noise or a glitch. You have to investigate it as a genuine, forward-looking signal from the market's radar. All right, we've covered some serious ground today. You now understand the lead-lag relationship, you've got that 6 to 12-month window locked in, and you know exactly why you always trust the market over the headlines. But that leaves us with a pretty provocative question, right? If the market moves before the economy, what exactly are the forces moving the market itself, moment to moment? What actually flips the switch? Well, that is exactly what we're going to unpack in our next explainer, where we'll look at the specific earnings number that, spoiler alert, isn't the number everyone thinks it is. Thanks for hanging out, and keep your focus on the big picture.